The screens in London, New York, and Shanghai are glowing red. And for the first time in decades, it's not because of a crash. It's because the system is overheating. Silver didn't just break a record. It shattered a reality that has governed the financial world for over 40 years. On December 26th, 2025, as the world was coming out of its holiday haze, the ticker did something it was never supposed to do. It crossed $79. To be exact, it hit $79.28 an ounce. Just 3 days prior, we were sitting at $71. Think about that move. That is a 10% vertical explosion in 72 hours. This isn't normal market behavior. This is what we call a breakaway gap. This is the moment where the paper contracts. The digital IOUs that have suppressed this metal for a generation finally lost their grip. Listen, if you've been following the markets, you know that $80 has been the impossible number. It was the line in the sand. But on December 26th, the sand was washed away. We aren't just looking at a price spike. We are looking at a total decoupling of the physical world from the digital one. The shorts, the massive banks that have been betting against silver for years, they didn't just lose, they capitulated, they scrambled, they panicked. The volume we saw on that Friday was unlike anything since the 2011 peak, or even the Hunt brothers run in 1980. But this time it's different. In 1980, it was two brothers trying to corner a market. In 2025, it's the entire world trying to find metal that simply isn't there. Look at the history. Think back to 2011. Silver hit nearly $50 and the world thought the moon was the next stop. But the powers that be raised margin requirements. They flooded the market with paper. They crushed the momentum. And for 14 years, silver became the forgotten asset. It stayed stagnant while tech stocks went to the stratosphere. But while we were all looking at AI and Bitcoin, something was happening in the background. The vaults were being drained, slowly at first, then all at once. In early December 2025, we saw the first cracks. Silver was at $60. People were calling it a blow-off top. They were wrong. It was a pressure cooker, finally blowing its lid. Compare this to 2008. Remember the great financial crisis? Everything crashed. But gold and silver, after the initial panic, they took off. They became the only lifeboats in a stormy sea. Today, we are seeing a repeat of that lifeboat mentality, but with a massive industrial twist. We've seen this before, this pattern of suppressed prices followed by a violent, unstoppable correction. But we've never seen it with the inventory levels this low. The COMEX vaults, the place where the West supposedly keeps its silver, are looking like a ghost town. When silver crossed $79 on the 26th, it wasn't because of a rumor. It was because someone somewhere realized that the vault was empty, and they were willing to pay any price to get what was left. Let's talk about the data. Let's look at the numbers, and I want you to listen to them slowly. Let them sink in. On December 22nd, silver was trading at $69.05. It felt high. It felt like it might pull back. But then came December 23rd. The price jumped to $71.48. That's a 3.5% gain in a single day. Most traders would call that a monster day, but the market was just warming up. We went through Christmas Eve at $71.91. We sat through Christmas Day with the markets closed, but the tension was building. Then came the 26th, the Boxing Day breakout. While most people were returning gifts, the silver market was delivering a message, $79.28. That is a 10.3% move in a time frame where nothing is supposed to happen. Why? Because the Shanghai Gold Exchange was already trading at a massive premium. For weeks, the East has been telling the West that their paper prices are a lie. In Shanghai, physical buyers were already paying the equivalent of $78 an ounce, while the COMEX was trying to pretend it was only $72. You cannot have a price difference that large for long. It's called arbitrage. And when it breaks violently. The data tells a story of a supply-side surrender. On December 26th, the gap between the paper price in New York and the physical price in Shanghai finally collapsed. New York had to chase Shanghai. It had to, or else every single ounce of silver in the West would have been shipped east overnight. This is the East-West decoupling we've been warning about for years. It's no longer a theory. It's a recorded fact on the charts. If you look at the volume on the 26th, it was heavily concentrated in the final hours of trading. This tells us one thing: the shorts were being forced out. They were buying to cover at any price just to survive the weekend. But let's go deeper into the why. Think about the industrial demand. In 2025, we are projected to use over 250 million ounces of silver just for solar panels, just one industry. That is more silver than the world produces in several months. Now add in electric vehicles. Add in the silver needed for the AI data centers that are popping up in every corner of the globe. Every one of those chips, every one of those connections, it needs silver. And the manufacturers? They are finally realizing that they can't build $1 trillion industry on a paper promise. They need the metal. They need it in their warehouses. They need it now. The December 26th surge was the sound of a supply chain snapping. It was the sound of industrial giants, think the Teslas and the Apples of the world, realizing that they are in a bidding war against investors for a finite resource. When you see a 10% move in 3 days, you aren't looking at investment demand. You are looking at panic procurement. You are looking at a world that has finally realized that you can print money, you can print digital contracts, you can print paper silver, but you cannot print the atoms. You cannot print the metal. Think about the psychology of the $79 level. For years, $49, the 2011 high, was the ceiling. Once we cleared that earlier in 2025, the sky became the limit. But 79, that's different. $79 is the threshold where silver stops being a cheap industrial byproduct and starts being a strategic metal. It's the price point where the miners start to rethink everything. It's the price point where the central banks who have been focused on gold start looking at their silver reserves, or lack thereof. The data for the last week of December 2025 will be studied in textbooks for the next 50 years. It is the perfect example of a coiled spring finally letting go. We saw a cumulative monthly decline in COMEX inventories of over 9 million ounces in December alone. That is nearly 2% of the entire vault, gone in 24 days. And the delivery requests? In the first 4 days of December, 47 million ounces were claimed for delivery. That is 60% of the registered silver. The stuff that is actually for sale being snatched up in less than a week. The system was designed to handle a few delivery requests here and there. It was never designed for a run on the bank. And that is exactly what we saw leading up to the 26th. A run on the silver bank. People weren't just buying the price, they were demanding the bars. They were pulling them out of the vaults and putting them into private storage. When you take the metal out of the system, you kill the ability of the banks to lease it out and suppress the price. You break the lever. And on December 26th, the lever finally snapped. We have reached the point of no return. The numbers from December 26th, that $79.28 close, isn't just a peak. It's a new baseline. The market has signaled that the old days of $20 silver, or even $50 silver, are dead. We are entering a new era of physical dominance, an era where the person holding the metal makes the rules, and the person holding the paper is just holding a piece of history. They were buying to cover at any price just to survive the weekend, and that is exactly where the mechanics of this squeeze get truly fascinating. Because, you see, once the price crosses a threshold like $79, the why behind the move shifts from simple supply and demand to something much more aggressive. We're talking about gamma squeezes and short covering on a global scale. Think about the whales. Think about the massive institutional players. For decades, the big bullion banks have played a very specific game. They sell paper silver on the COMEX, contracts that represent silver that does not necessarily exist in physical form to keep the price suppressed. It's a profitable game, as long as nobody asks for the metal. But in December 2025, everybody started asking for the metal at the exact same time. When silver hit $79, the algorithms triggered. These automated systems are designed to limit losses. When the price moves too high, too fast, the computers are forced to buy silver to close out their losing bets. This creates a feedback loop. The price goes up, which forces the algos to buy, which pushes the price even higher. It's a literal vacuum of buy orders. And then there are the industrial whales. We're talking about the massive tech companies that have historically relied on just-in-time inventory. They didn't worry about silver in 2023 or 2024 because it was always there, sitting at $25 or $30. But now they are looking at a market where the Shanghai premium is $8 an ounce. They are looking at a market where the lease rates, the cost to actually borrow silver for manufacturing, have spiked to 30%. Imagine you're a procurement officer for a major solar firm or a high-end electronics manufacturer. Your job is to ensure the factory keeps running. If you don't have silver, the factory stops. And if the factory stops, billions are lost. So what do? You stop looking at the COMEX ticker and you start making phone calls. You call the miners directly. You bypass the exchanges entirely. This is what we call direct offtake. We've seen hints of this with companies like Tesla and their interest in lithium and nickel, but silver is the Achilles heel of the green energy revolution. In late 2025, the rumors turned into reality. The reports of industrial giants bypassing the paper market to secure physical metal directly from the source were the fuel for the fire. When the paper market realizes the physical supply is being diverted before it even reaches the exchange, that's when you see a 10% move in 3 days. But let's look at the psychology of the deep dive. Why now? Why did the breaking point happen on December 26th? It's because of the year-end positioning. Every fund, every bank, and every institutional trader has to market their positions at the end of the year. If you are short silver, and silver is up 100% on the year, your balance sheet is a disaster. You're looking at massive realized losses. The panic we saw on the 26th was the sound of professional traders throwing in the towel. They couldn't afford to carry those short positions into 2026. They had to capitulate. Think about the backwardation we mentioned earlier. This is a technical term, but it's vital to understand the why. In a normal market, the price for delivery in the future is higher than the price for delivery today. That's because it costs money to store and insure the metal. But in late December 2025, the silver market went inverted. The price for immediate delivery was higher than the price for delivery 3 months from now. This is the market's way of screaming, we need the metal now. It's a distress signal. It means the warehouses are empty and the users are desperate. Now, let's pivot to the solution. Because in the middle of this chaos, in the middle of this massive price spike, you have to ask yourself, is this a trap or is this the opportunity of a lifetime? For years, the silver bugs were mocked. They were told silver was a dead asset. They were told it was a pet rock. But on December 26th, those pet rocks became the most valuable insurance policy on the planet. The solution isn't just about chasing the price higher. It's about understanding the new reality of the silver market. Here's the thing. When a market undergoes a structural repricing like this, the old rules go out the window. You cannot look at a chart from 2020 and expect it to tell you what's going to happen in 2026. We are in price discovery mode. That means the market is searching for the level where supply and demand actually meet without the interference of paper manipulation. Is that $80? Is it $100? Or is it something much higher? The first part of the solution is to stop thinking of silver as a trade. If you're trying to day trade a market that moves 10% in 3 days, you are going to get burned. The volatility is too high. The margin calls are too aggressive. The solution for the long-term builder is to look at silver as a strategic asset. It is no longer just a precious metal, it is a critical mineral. The same way the world looks at oil, or copper or lithium, that is how we must now look at silver. You have to realize that the loyalty in this market isn't to a ticker symbol, it's to the physical reality of the metal. If you are holding physical silver, you aren't just an investor. You are a liquidity provider. In a world that is bone dry, the solution involves a total shift in perspective. You have to move away from the fear of missing out and toward strategic accumulation. Listen, $79 feels expensive if you've been rethinking about the silver of 2019, but it feels incredibly cheap if you're rethinking about the silver of 2030, a world where solar energy is the primary power source and every car on the road is a rolling computer filled with silver contacts. The solution begins with a calm, rational analysis of the supply-demand deficit. If the world is short 200 million ounces a year and inventories are at 40-year lows, then the price has to go to a level that either forces people to stop using it or forces miners to dig more of it up. And here's the hard truth. You cannot dig more up overnight. It takes 10 years to bring a new silver mine online. 10 years. That means for the next decade, we are stuck with the supply we have. This isn't like a software company that can scale its production with a click of a button. This is geology. This is chemistry. This is the physical world. The solution, therefore, is to recognize that we are in the early stages of a multi-year supercycle. But you have to be careful. In a melt-up like this, the exchanges often change the rules mid-game. We saw it in 1980. We saw it with GameStop. We saw it with nickel on the LME. When the shorts are about to go bankrupt, the exchanges sometimes step in to save them by halting trading or forcing cash settlements. This is why the solution must include a focus on physical possession. If you don't hold it, you don't own it, especially when the system is under this kind of stress. Think about the loyalty building aspect of this. We are talking about building a portfolio that can withstand a total systemic reset. Silver is the canary in the coal mine. Its move to $80 is a warning that the paper world is losing its ability to control the real world. As we move into 2026, the solution is to lean into that reality. Don't be the person chasing the spike on the 26th. Be the person who understood the fundamentals months ago and is now watching the world finally catch up to your thesis. But even if you're late to the party, there is a way to approach this. You have to look for the consolidation. After a 10% move, the market needs to breathe. It needs to settle. It needs to establish a new floor. The $79 level will be tested. It will be volatile. But the solution is to look past the daily noise and focus on the signal. The signal is simple. The vaults are empty. The East is buying. The tech giants are panicking. And the supply isn't coming back anytime soon. Think about the value proposition here. We are looking at a metal that is essential for the future of humanity. We are looking at a market where the primary price-setting mechanism, the COMEX, is failing. The solution is to prepare for a world where silver is no longer cheap, a world where it is treated with the same reverence as gold, but with the added utility of being an industrial powerhouse. As we look toward the final chapters of this silver saga, we have to address the endgame. What happens when the paper market finally breaks for good? What happens when the world moves to a spot-only pricing model? This isn't just a financial question. It's a geopolitical one. It's about the shift of power from west to east. It's about the shift from digital wealth back to tangible wealth. The move on December 26th was the first act of this endgame. It was the moment where the curtain was pulled back and the world saw the reality of the situation. The vaults weren't just low, they were critically low. The premiums weren't just high, they were structurally high. And the price wasn't just rising, it was accelerating. If you want the solution, if you want the perspective that builds true wealth and loyalty to a sound financial strategy, you have to be willing to look at the data that everyone else is ignoring. You have to be willing to look at the physical flow of the metal, because at the end of the day, the charts are just lines on a screen. But the silver is real, it's heavy, it's conductive, and in 2025, it's finally becoming priceless. It's finally becoming priceless, and that is the terrifying part for the banks, because once something becomes priceless, it becomes untradeable. This brings us to the second half of the solution, and it is the part most people are afraid to hear. You have to prepare for the cash settlement event. Think about the COMEX. It's an exchange. Its job is to facilitate trade. But when the registered inventory drops below a certain level, and we are fast approaching that level, the exchange has a nuclear option called force majeure. It means they can essentially say, we know we promised you 10,000 ounces of silver, but we don't have it. So instead of the metal, here is a check for the cash value at yesterday's closing price. If you are a manufacturer who needs that metal to build solar panels, that check is worthless. You can't build a solar panel out of paper money. This is why the solution for 2026 involves a total pivot toward physical delivery. If you are an investor, this means looking at products like the Sprott Physical Silver Trust, which actually holds the bars and allows for redemption, or simply holding the coins and bars in your own possession. The move on December 26th to nearly $80 was a warning shot that the Picaspinner's paper to physical conversion is becoming a bottleneck. And let's talk about the gold-silver ratio, because this is where the math gets truly explosive. For most of the last few years, the ratio has been sitting at 80 to 1 or even 90 to 1. It took 90 ounces of silver to buy 1 ounce of gold. But look at where we are today. With gold at $4,400 and silver at 80, that ratio has collapsed to 55 to 1. Historically, when silver enters a mania phase, that ratio doesn't just settle, it reverts. In 2011, it hit 31 to 1. In 1980, it hit 17 to 1. If we see a reversion to just 30 to 1, a very reasonable historical average for a bull market, and gold stays at $4,400, now do the math. Silver wouldn't be 80, it would be $146 an ounce. That is the gravity that is pulling silver higher. It's not just about silver, it's about silver's relationship to its big brother, gold. Now, I want you to think about 2026, because as we sit here on December 27th, looking at the wreckage of the short sellers, the outlook for the next 12 months is unlike anything we've seen in our lifetimes. We are entering a period where the deficit isn't just a number on a spreadsheet, it's a physical reality that will start affecting your daily life. We're likely to see strategic stockpiling by nation states. China is already doing it. India is importing silver at record rates. Do you think the US or the EU will sit back and let their green energy dreams die because they didn't secure the metal? No. They will enter the market as buyers of last resort. When governments start competing with industrial giants and retail investors for the same ounce of silver, $80 will look like a bargain. So here is your actionable perspective. First, audit your exposure. If you're holding silver through a standard brokerage account, you need to understand that you are at the mercy of the cash settlement rules. You are holding a claim on silver, not the silver itself. Second, understand the silver flood risk. Some analysts will tell you that at $80, everyone will melt down their grandma's silverware and flood the market with supply. Listen, that happened in 1980, but the world is different now. Most of the silver we've used in the last 30 years is sitting in landfills in the form of old cell phones and circuit boards. It is non-recoverable at current prices. It would take silver at $200 to make it profitable to mine our trash. So don't wait for a scrap supply miracle to save the market. It's not coming. Third, watch the lease rates. If you see the cost to borrow silver staying above 20 or 30%, it means the shortage is deepening regardless of what the price is doing. The price can be manipulated, but the lease rates, those represent the desperate reality of the physical market. Think about the loyalty we discussed at the start. True loyalty in finance isn't to a person or a brand, it's to the truth. And the truth is that for 40 years, we lived in a world of abundance. We thought we could have everything we wanted whenever we wanted it just by clicking a button. But the 2025 silver squeeze has proven that the abundance was a digital illusion. We are moving back into a world of scarcity. $79.28. That was the price on December 26th. But the value is much higher. The value of silver is the value of the modern world. Without it, there is no green transition. There is no AI revolution. There is no high-tech future. As we close out this deep dive, I want you to take a breath and look at the big picture. Don't let the daily volatility shake you. If silver drops to 70 or spikes to 90 next week, it doesn't change the fact that the vaults are emptying. It doesn't change the fact that China is willing to pay an $8 premium for every ounce they can get. It doesn't change the fact that we are in the 5th consecutive year of a massive structural deficit. The Economy Decoded mission has always been to show you the gears behind the machine. And right now, the gears are grinding. The silver market is the primary friction point in the global financial system. If silver breaks, the paper currency system faces its greatest challenge since the 1970s. This isn't just about making a profit on a trade. It's about positioning yourself on the right side of a historic wealth transfer. The melt-up isn't a glitch, it's a correction. It is the market finally acknowledging that silver has been the most undervalued asset on Earth for a generation. And as that realization spreads, as the FOMO turns into fear of not being able to buy at all, the numbers we are seeing today will become the old lows that we talk about with nostalgia in 2027 and 2028. So here's my question for you. If the COMEX declares a cash settlement tomorrow and you receive a check instead of your silver, where will you go to buy the physical metal? Because at that point, there might not be anyone left who is willing to sell. The vaults are draining. The East is setting the price. The silver supercycle is no longer a prediction. It is our current reality. Stay sharp, stay physical, and above all, stay informed. If this deep dive helped you understand the chaos of the last 72 hours, make sure to subscribe. We are tracking the COMEX delivery data every single day as we move into the January 2026 delivery month. It's going to be a wild ride. What is your personal floor for silver? Are you a buyer at 80, or are you waiting for the $100 breakthrough? Let me know in the comments. I'll see you in the next one. Disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor. The information provided here is based on current market data and historical analysis as of December 27th, 2025. Precious metals are highly volatile and carry a significant risk of loss. Always conduct your own research and consult with a certified financial professional before making any investment decisions. Past performance, including the 150% gains of 2025, is not a guarantee of future results. The silver market is subject to sudden regulatory changes and exchange-driven interventions that can impact liquidity and price.